David Kudla, founder, CEO, and CIO of Mainstay Capital Management, joins us here. David, we've got rising interest rates. And the question is how fast, how much. How do you position your portfolio for an environment that we haven't seen in quite some time?
Good morning, Matt and Paul. And that's a very good question. I think a lot of investors are asking themselves, because if you look at the 60-40, that classic 60-40 mix this year as an investor, or anything around that it has, stocks of the S&P 500, some stocks of the NASDAQ, and, look at the U.S. aggregate bond index, you're pushing a negative 10% return, or close to that, or a little bit more, depending on your mix of stocks. With the U.S. aggregate bond index down over 9% this year, we know the statistics. It would be the worst year on record. So we're tactical asset allocators at Mainstay Capital Management. So we have been in the first part of this year, we have been short bonds, and that's specifically treasuries, high-grade corporates that are very interest rate sensitive. I think that was prudent with what we know is coming from the Fed. And we've seen, all along the curve from 2s to 10s anticipate that. And in stocks, we're long commodities. We're significantly overweight commodities, most we've ever been in the history of the firm. And then in stocks, we're picking our places.
At what point,
that's the
David,
second time we've heard commodities today, Dave.
Yeah, we have. And I'm going to ask David the same question that I just asked a few minutes ago in a different way. Because, okay, you've made the right bets and you've profited on that. At what point do you take some money off the table? Because now everyone is saying get into commodities. And at that point, I start to ask myself, is the trade over?
Yeah, and you've mentioned before my presence on Twitter, and I've, teased, not trolled, but teased some of the people talking about commodities now. It's like, good call, but you're a little bit late to the game, and that's, commodities has been a good play for a year, but especially these last, 4 or 5 months, it's been incredible. We had all the reasons for coming into that space that was heightened by Ukraine. And COVID lockdowns in China. We've seen the Ukraine premium get built in and taken back out. But we think the fundamentals are still there for commodities to go, not at the rate they have been maybe in the first 4.5 years. But, if you look at the environment we're in an inflationary environment for a while here. We have some of the elements of 1970s style stagflation. But if you look back in the 1970s when inflation was running, at a very high rate, what asset class did the best during that time frame? And it was commodities. Now, the short treasuries, we're going to be scaling that back because we've seen a lot of that get built in already. And I think we're going to see, interest rates more leveling out, maybe some more risk to the upside, but certainly not the run-up we've had since December.
Are you in the camp that has, a reasonable concern that this Federal Reserve is going to move too quickly, too much, and in fact push this economy not into a slowing growth rate, but into actual recession?
Yeah, that is our fear. And, if I had to put odds on it right now, I'd say it's maybe still 50-50, but it depends on how they actually execute. I mean, if you look at how far behind the curve they are and maybe how slow and deliberate, we're going to hear from Jerome Powell later today, but how slow and deliberate, they've been. They literally let QE run right up to the first rate hike. In the first week of March, they were still buying, $4.1 billion in assets. It literally ran right up to the meeting, and it was a quick pivot to QT. And now we're talking about 50 basis point rate hikes, and with Bullard maybe 75. But we've got a couple in there, and so when they move that far that fast, that's when we're concerned about them breaking something. We had portions of the yield curve inverting earlier, several weeks ago, and that's there are some historical precedents there. But aside from that, it's just that they could move far enough and fast enough that they could lead us into a recession or a meaningful slowdown. Right now, things still look good. Corporate profits are coming in very well for the first quarter.
Yep.
Economy's still humming along, but there is concern as we get in the second part, or really into 2023.
Hey, David, you're the founder, sponsor of Engage, which is the world's largest student stock pitch competition and conference at the University of Michigan. Are we having one of those this year, or is it going to be in person? Give us what's the status?
It's virtual. We're
Okay.
still trying to be, respect for, the concerns about the ongoing COVID issue. And so virtual last year, virtual again this year, but we will certainly be back to an in-person conference next year, which I like for students so that when we bring in all these professionals, they have the chance to interact with them and network with them one-on-one.
Yep, that's some great stuff, David, that you do there with that conference, again, at the University of Michigan. David Kudla, founder, CEO, CIO of Mainstay Capital Management, Grand Blanc, Michigan. Engage conference is really good. I know a lot of schools participate that, and they get some real good experience in terms of the markets and investing, and they get to interact with a lot of professional investors.